What if I told you that the wealthiest people on the planet aren't just playing a different game when it comes to money, they're playing on a completely different field? I'm here to tell you that Wall Street has a dirty little secret, and it has nothing to do with day trading or picking the next hot stock. It's a playbook for building resilient, generational wealth that's deliberately kept complex and out of reach. Today, I'm exposing how they really use sophisticated diversification and private market access to all but ensure they win, no matter what the market is doing. This isn't some get-rich-quick fantasy. This is about understanding a fundamental shift in strategy that separates the ultra-wealthy from everyone else. It's a strategy that I see prioritizing resilience as much as growth, creating a financial machine built to last for generations. And while you might not have $1 billion, understanding their playbook can fundamentally change how you approach your own financial future. I'm about to decode the very architecture of elite wealth for you. For decades, they've sold us, the average investors, a simple, almost comforting story: the 60-40 portfolio. You put 60% of your money in stocks for growth and 40% in bonds for safety. Set it, forget it, and you'll be fine. It's the financial equivalent of being told to eat your vegetables, sensible, but dangerously incomplete. The problem? That old way was designed for a world that doesn't exist anymore. It was built for predictable economic cycles and a clear line between public and private companies. Today's markets are a different beast. We live in an age of geopolitical shocks, dizzying technological disruption, and interest rates that pivot on a dime. That smooth, upward trending line the 60-40 promised now looks more like a roller coaster, and from where I sit, the ride is getting nauseating for many of you. This conventional wisdom leaves most people exposed. Their entire financial world is tied to the whims of the public markets. When the S&P 500 has a great year, they feel like geniuses. When it plummets, their retirement evaporates. They're sitting at a poker table with only 2 moves, while the players in the back room have a full deck and a stacked hand. When I look at how the ultra-wealthy really invest, I see a totally different picture. While allocations vary, many have dramatically reduced their reliance on traditional bonds, moving far away from the old 40% rule for safety. They've built something far more robust, realizing that true safety doesn't come from one asset zigging while another zags. It comes from having multiple, uncorrelated engines of growth working at the same time. The secret isn't just that the 60-40 portfolio is outdated, it's that the elite stopped using it as their core strategy long ago. So, if they aren't just buying stocks and bonds, what are they doing? This is the heart of the secret. The financial elite don't think in terms of stocks and bonds. I think in terms of a whole portfolio. They see their wealth not as a messy collection of investments, but as a single, integrated machine designed for one purpose: perpetual growth and preservation. The strategy is twofold. First, radical diversification across both public and private markets, and second, securing access to those private markets where explosive growth happens long before you or I hear about it. This is the playbook they don't discuss on cable news. It's a strategy institutional investors have perfected for decades, heavily influenced by the endowment model pioneered by universities like Yale. That model showed that with a long-term view, you could get better risk-adjusted returns by allocating huge chunks of capital to illiquid, alternative investments. What are these alternatives? I'm talking about private equity, venture capital, private credit, real estate, infrastructure, and hedge funds. For many of these investors, public stocks might only be one piece of the puzzle, sometimes making up less than half of their total holdings. The majority of their wealth is often at work in asset classes you can't even find on a normal brokerage account. Why? Because it gives them different kinds of growth and different layers of defense. Public stocks give you liquid access to mature companies. Private equity lets you own a piece of a business before it goes public, capturing its most explosive growth. Infrastructure, like airports or data centers, provides stable, inflation-linked cash flow that acts as the portfolio's bedrock. And private credit offers higher yields than traditional bonds, with different risk factors. Each piece has a job. It's like building an elite special forces team instead of an army of foot soldiers. This whole portfolio approach is designed to be anti-fragile. It doesn't just survive volatility, it's built to find opportunities in it. This is the real game, owning a slice of the entire economy, public and private, liquid and illiquid, to build an almost unshakable financial fortress. Let me start with the most powerful growth engine in the elite investor's toolkit, the private markets. This is where I see truly transformative wealth being born. When you hear about innovative giants like SpaceX or fintech disruptors like Revolut, you're talking about companies that grew for years in the private sphere before even thinking about an IPO. The ultra-wealthy don't wait for the IPO. They invest directly. Private equity, simply put, is buying ownership in companies not listed on a public stock exchange. This can be a buyout fund purchasing a mature company to improve it, or a growth equity fund investing in a business that's rapidly scaling. It's no surprise that a significant number of billionaires continue to show strong interest in increasing their private equity investments, seeing it as a core engine for growth. As an individual's net worth climbs, their allocation to private equity and direct business ownership tends to jump, sometimes making up over a third of their portfolio. Venture capital, VC, is a type of private equity focused on high-potential startups. It's the riskiest corner of the market, but also offers the highest returns. A single successful investment can return 10, 20, or even 100 times the initial capital. So why is this so effective? 3 reasons. First, access to the primary growth phase. A company's fastest growth happens when it's private and agile. By the time it goes public, the early investors have often already reaped the biggest rewards. Second, control and influence. Unlike buying a few public shares, private equity funds often take an active role, joining the board and driving strategy to create value. They manufacture returns, they don't just wait for them. And third, inefficiency is opportunity. The public markets are hyper-efficient. The private markets are opaque and relationship-driven. This creates openings for skilled investors to find undervalued assets and generate alpha, or returns above the market average. It's a space where deep expertise and connections pay off. Of course, this world is walled off for a reason. The minimum buy-in for a top fund can be millions, and the money is often locked up for a decade or more. It is, by design, a club for the patient and the very, very wealthy. But its role is critical to understanding elite wealth creation. It is their dedicated engine for capturing returns that are nearly impossible to find in public markets alone. While private equity is the growth engine, the real genius of the playbook is the fortress they build around it with other, non-correlated assets. This is what real diversification looks like. It's not just owning different stocks, it's owning different income streams and different hedges against uncertainty. Let's look at the other key parts of this fortress. First, real estate and infrastructure. The wealthy have always understood tangible assets. They invest heavily in commercial real estate, not just for appreciation, but for steady rental income. But they've gone beyond that. They are major investors in infrastructure, toll roads, airports, data centers, and renewable energy projects. These assets provide long-term, often inflation-linked cash flows that aren't tied to the stock market's daily mood swings. Real estate has always been a cornerstone for the wealthy, and its appeal as a tangible store of value and lifestyle investment remains incredibly strong across generations. Second, private credit. While the average investor is told to buy government bonds for safety, the ultra-wealthy are increasingly becoming the bank themselves through private credit. They lend money directly to companies, often at higher interest rates than the public bond market offers. In an environment where traditional bond yields can be low, private credit has become a crucial source of attractive, predictable income, filling the role bonds used to play but with higher potential returns. Third, hedge funds and other alternatives. This is the most misunderstood part of the portfolio. Hedge funds aren't just for making wild, speculative bets. They use a vast range of strategies. Some are designed to make money whether the market goes up or down. Others trade on global macro trends. The goal isn't always to shoot the lights out, it's to generate returns that are uncorrelated to the stock and bond markets, smoothing out the portfolio's performance, especially during times of stress. This multi-asset approach creates a portfolio that is both resilient and dynamic. It draws on the principles of an all-weather strategy, which balances assets to perform across different economic seasons, rising or falling growth, and rising or falling inflation. They hold cash not just for safety, but as dry powder, ready to deploy when other assets go on sale. It's a strategic allocation of capital that's the complete opposite of the passive, hope for the best 60-40 portfolio. So why all this complexity? Why not just dump everything in a low-cost S&P 500 fund and call it a day? The answer is one word: resilience. The goal of the ultra-wealthy isn't just to get rich, it's to stay rich and grow that wealth across generations, no matter what the world throws at them. This strategy isn't about hitting home runs every year, it's about optimizing risk-adjusted returns over decades. The whole portfolio approach builds a financial machine with multiple layers of defense. A portfolio of only public stocks is like a high-performance race car. On a perfect day, it's unbeatable. But hit an oil slick, and it can spin out of control. The elite portfolio is an all-terrain, armored vehicle. It might not be the fastest on the straightaway, but it can navigate any environment. Private equity is its powerful engine. Real estate and infrastructure are its heavy-duty tires, providing stable traction. Private credit is a reliable auxiliary power unit. And hedge funds are its advanced navigation and defense system, avoiding obstacles and protecting against unexpected attacks. This structure is built for market downturns. When the public markets crash, the average investor can only sell at a loss or hold on and pray. The elite investor's portfolio is ready for this moment. The cash flows from their infrastructure and real estate keep pouring in. Their market-neutral hedge funds might even be up. And crucially, they have dry powder, ready to buy high-quality assets at bargain prices from those who are forced to sell. This is how the rich get richer during a crisis. They don't just survive downturns, they capitalize on them. This strategy decouples their financial fate from public market sentiment. Their wealth grows from multiple, uncorrelated sources, creating a smoother, more predictable path over the long term. It's a shift from being a passenger on the market's roller coaster to being the owner of the entire theme park. At this point, you're probably thinking, this is great, but I don't have $10 million to buy an airport. What am I supposed to do? It's a fair question. I know you may not be able to replicate a billionaire's portfolio, but you can absolutely adopt their philosophy. The principles are universal and can make you a much smarter investor. First, think beyond the 60-40 and your home country. The core lesson is broader diversification. Most investors have extreme, home country bias. The wealthy think globally. You can do this too, through low-cost ETFs that give you exposure to international and emerging markets. Second, access alternatives in liquid form. While you can't buy into a private infrastructure fund, you can invest in publicly traded infrastructure companies or real estate investment trusts, REITs, that own data centers, cell towers, and warehouses. These can give your portfolio some of the same inflation hedging and stable cash flow characteristics the wealthy get from direct private investments. Third, rethink what safety means in your portfolio. The ultra-wealthy are looking beyond traditional bonds for income. While you should keep a portion of your portfolio in high-quality, liquid bonds, you can explore other sources of yield. The fixed income universe is broader than just treasuries, and understanding that is a key mindset shift. Fourth, and most importantly, adopt a long-term, opportunistic mindset. The wealthy hold cash because they are patient predators waiting for opportunity. For you, this means having an emergency fund and cash on the sidelines, so when the market inevitably panics, you can be a buyer, not a forced seller. Thinking in market cycles, not news cycles, is perhaps the most valuable lesson of all. By applying these principles, global diversification, adding liquid alternatives, and being patient and opportunistic, you can start building a portfolio that is far more resilient and aligned with the proven strategies of the world's most successful investors. So there it is. Wall Street's dirty little secret isn't a complex trading algorithm or a hot stock tip. It's a philosophy: build a fortress, not a race car. It's about meticulously constructing a whole portfolio machine with diverse, uncorrelated parts, public stocks, private companies, tangible assets, and sophisticated alternatives, all working to deliver resilient growth through any economic weather. While the doors to direct private equity may be closed for most, the principles are not. By expanding your definition of diversification, thinking globally, and embracing a long-term, opportunistic mindset, you can build a more robust and resilient financial future for yourself. If this breakdown was valuable to you, make sure you subscribe and turn on notifications. I'm just getting started on decoding how money really works. Thanks for watching.